$70 for an ounce of silver. Numbers like that once belonged to mythology, whispered in trading floors' break rooms and long-forgotten Bloomberg terminal screens. But in late December 2025, silver didn't just flirt with $70. It charged toward it with a velocity that stunned markets worldwide, a move so dramatic that analysts and investors alike began to wonder if they had walked through a financial looking glass into a realm where old rules no longer applied. By year's end, it wasn't just the price that had risen. It was the questions, the theories, the sheer bewilderment at what forces could push a centuries-old metal so high, so fast. But behind the ticker symbols, the statistics and the breathless headlines lies a deeper, more unsettling narrative. Is this rally merely the product of macroeconomic forces, or does it reflect something far more deliberate, a meticulously timed market strategy with political overtones? In the closing weeks of 2025, silver's price repeatedly climbed above $69 per ounce, edging ever closer to that psychological and technical threshold of $70, a level that, mere months earlier, many seasoned commodity traders believed was implausible. This wasn't a gradual ascent, it was a surge, fueled by intersecting threads of monetary policy, geopolitical stress, investor psychology, and structural market imbalances that few could have fully anticipated. As markets priced in expectations of additional U.S. Federal Reserve rate cuts in 2026, safe haven flows toward precious metals accelerated, with silver at the forefront of a broader precious metals bull market. Gold soared to unprecedented heights above $4,400 per ounce, providing powerful gravitational pull on investor capital, while silver outpaced even gold with gains exceeding 135% this year, drawing attention not just for its magnitude, but for its sheer velocity. Investors and commentators offered competing explanations: supply deficits, surging industrial demand, ETF inflows ripping through previous records, and a weakening dollar that made hard assets more attractive. But the more the price climbed, the more the narrative fractured into competing theories. Some called it a classic market revaluation, a long overdue pricing of silver's dual role as both a commodity essential to electrification and green technologies, and as a monetary hedge in times of uncertainty. Others whispered of technical squeezes, tight inventories, and derivatives, positioning so extreme that it resembled the dramatic episodes of the early 1980s or the 2011 precious metals bull run. Yet, over time, another thread wove its way into the collective discussion, one that involved the most polarizing figure in American political and economic discourse: Donald J. Trump. This wasn't to say that anyone had come forward with irrefutable proof of illicit manipulation. No regulator had issued charges, no subpoena had been leaked. What emerged instead was a mosaic, a pattern of public statements, policy preferences, rate cut advocacy, geopolitical posturing, and economic uncertainty that, when viewed together, raised questions that markets rarely ask so openly. Could political influence be shaping the very movements of a global commodity? Picture the situation that brought silver here. Industrial demand was real, even structural. Silver's use in solar photovoltaics, electric vehicles, data centers, electronics, and next-generation energy grids had driven industrial fabrication to record levels, accounting for a majority share of total silver demand. Meanwhile, supply remained tight. The global market had endured consecutive annual deficits as mine production, constrained by underinvestment and declining ore grades, failed to catch up with demand. Primary silver mines accounted for a fraction of global output, with much of the rest as a byproduct of base metal and gold mining, a dynamic that dampens supply responsiveness even when prices climb. On top of this structural backdrop, demand wasn't just industrial. Investment demand, and particularly through exchange-traded products backed by physical silver, surged. SLV, PSLV, and other bullion vehicles drew record flows, removing tangible metal from available inventories and placing it into vaults around the world. Futures markets saw net long positions expand, while deliverable inventories at major exchanges like COMEX shrank to levels so tight that backwardation, where spot prices exceed futures, became a recurrent feature, a rarity that normally signals intense physical demand relative to paper supply. These forces on their own might have explained a powerful rally. But in 2025, they did not operate in isolation. They coincided with an extraordinary backdrop of monetary and fiscal uncertainty. Throughout the year, the Federal Reserve signaled an easing bias, with markets pricing in at least 2 significant rate cuts in 2026. As yields on bonds fell and real yields compressed, non-yielding assets like gold and silver became more attractive, a relationship well understood by commodities strategists and value managers alike. But at the same time, monetary loosening was being debated not just on economic grounds, but political ones. Public pressure, commentary, and criticism from influential figures linked to the Trump administration directed attention toward aggressive rate cuts and a weaker dollar. policies that historically benefit hard assets priced in dollars. For silver's rally, this meant a confluence of narratives. Macroeconomic forces made it plausible, technical conditions made it sharp, and political discourse made it charged. Retail investors, many of whom had once ignored silver in favor of equities or cryptocurrencies, suddenly found themselves inundated by charts, narratives, and price targets that seemed almost surreal. On forums, feeds, and social channels, speculation buzzed about $80, $100, even triple-digit silver. Traders watched prices jump as sentiment oscillated between fear and fervor, each uptick in the price validated by chatter that bordered on mythic. But behind the hype, there were real economic currents. ETFs reported inflows that outpaced all of 2024 combined. Industrial markets, especially in renewable energy and electrification, continued to demand more metal. Spot prices surged toward record territory as geopolitical tensions, from U.S. sanctions on Venezuelan oil to conflicts in Eastern Europe, drove safe haven flows into precious metals and weakened confidence in fiat alternatives. Combined, these market stresses didn't just lift silver, they launched it into historic performance territory unseen since the late 1970s. Yet, even as fundamentals were cited by bulls and bears alike, the manner of the rally's acceleration raised eyebrows. Silver's move wasn't a slow climb, it was a punctuated leap with sudden bursts that defied typical commodity patterns. Often, markets that are tightening structurally climb steadily, absorbed by gradual adjustments in supply and demand. But what traders were seeing was sudden high-velocity price action, an almost impulsive behavior more often associated with speculative squeezes or coordinated positioning. The telltale signs were there: compressed inventories, backwardation in futures markets, elevated lease rates for physical silver, and spiraling ETF flows that removed metal from circulation faster than producers could replace it. This was the kind of behavior that, in decades past, drew scrutiny from regulators and prosecutors. In the 1980 Hunt Brothers episode, concentrated buying in leveraged positions moved prices dramatically before regulatory intervention quelled the surge and forced a collapse. In 2011, a different suite of factors, credit stress, geopolitical unease, and commodity speculation, drove another violent rally. Today's market, while structurally different in scale and participation, shared a similar intensity in its pricing action. Yet no singular entity stood out as the driver. There was no Hunt-like figure publicly controlling a disproportionate share of the market. Instead, the momentum seemed diffuse yet synchronized, a collective force of institutional flows, retail momentum, geopolitical news, and macro positioning. This is where the question shifts from can markets be manipulated to how market psychology and political influence might intersect. Contemporary markets are shaped by instant communications, algorithmic trading, and narratives that spread globally in seconds. When a powerful public figure repeatedly criticizes policy, pushes for specific economic actions, and stokes expectations of looser monetary conditions, those messages don't just linger in the news cycle. They seep into price action. Market algorithms, portfolio managers, and global investors react not only to data, but also to expectations of future policy decisions. Over weeks and months, these expectations translate into sustained flows that can, in aggregate, push prices far beyond what short-term fundamentals might suggest. In the context of 2025, statements advocating for looser monetary policy or critiquing Federal Reserve independence carried added weight because markets were already sensitized to economic weakness, slowing growth, and deflationary pressures in key sectors. When political commentary aligned with trader expectations of rate cuts, sudden liquidity shifts, and weaker dollar forecasts, it became impossible to disentangle financial causality from perceived policy momentum. The narrative and the numbers, in effect, began to feed each other. A feedback loop that, from the outside, can resemble a form of indirect influence. Still, it's vital to stress that correlation is not proof of manipulation. Professional traders confidently assert that markets, especially those as deep and liquid as silver, cannot be controlled by political advocacy alone. Even the most influential figures can't spontaneously conjure leverage, physical inventories, or genuine industrial demand. What they can influence, however, are expectations. And in modern financial systems, expectations are often just as powerful as actual flows. Market psychology drives positioning, positioning drives liquidity, and liquidity, when sufficiently concentrated in one direction, can create self-fulfilling narratives that push prices into extraordinary territory. By the time silver hovered around $69, $70, markets were describing the rally as one of the most significant precious metals trends in over 4 decades. In 2025 alone, silver's year-to-date gains of over 130% outpaced gold's own historic climb, a testament not only to supply and demand fundamentals, but to the sheer force of capital rotating into hard assets in a world beset by monetary uncertainty. Institutional players played their part too. Bank analysts, from Bank of America to UBS and TD Securities, publicly revised their outlooks, noting that lower real yields, ongoing ETF inflows, constrained mine output, and resilient industrial demand underpinned silver's advance. At the same time, cautionary voices from the likes of Goldman Sachs and Citi noted silver's greater volatility compared with gold and stressed that elevated prices could incentivize recycling and new supply entry over time. The collective result was a market tension that blended confidence with caution, an explosive mix in any financial environment. And yet, even as silver climbed, cracks of doubt spread through the investor community. Some traders worried about overbought conditions, where technical indicators signaled markets that might be ripe for correction. Others pointed to elevated trading volumes in silver ETFs, suggesting frenzy rather than stable accumulation, raising the specter of a swift pullback once sentiment shifted. In October, before the 60-pluses run, charts showed surges in ETF trading volume that historically foreshadowed corrections in previous precious metals rallies, a reminder that dramatic upswings often carry the seeds of volatility and reversal. The media played its part too, weaving narratives of safe haven demand against a backdrop of geopolitical strain. With U.S. sanctions tightening on Venezuelan oil shipments, conflict in the Mediterranean involving Russian-linked tankers, and tensions flaring across multiple theaters, investors sought refuge in tangible assets. Precious metals, long regarded as bulwarks against instability and currency debasement, became not just hedges, but icons of economic fear and speculation. Each headline added fuel to a fire that was already roaring. Amid all this, the average U.S. investor found themselves at a crossroads. Many retail traders, having watched stock markets oscillate, bond yields languish, and fiat currencies falter, saw silver's ascent as validation of a thesis they'd held for years, that traditional financial systems were incomplete without real assets in the portfolio. Others, burned by past rallies that ended in sudden reversals, approached with caution, wary of a repeat of the 1980 or 2011 endings. And yet others watched silently, uncertain whether silver's run represented genius timing, structural repricing, or something more enigmatic and strategic. The truth, as with many dramatic market episodes, lies in ambiguity. There is no definitive evidence that any individual, political figure, or group orchestrated this rally through clandestine market intervention. But there is evidence that powerful narratives, macroeconomic shifts, geopolitical anxieties, and widespread expectation of monetary easing combined in a rare alignment that propelled silver into uncharted territory. In modern finance, where trillions of dollars move in milliseconds and narratives can be instantly amplified across global networks, markets are shaped not just by facts, but by collective belief systems. And few forces influence belief like the interplay of politics and economic expectation. As 2025 drew to a close, silver's price near $70 was more than a numeric milestone. It was a symbol of a financial moment where uncertainty reigned, capital sought refuge, and every participant, from institutional behemoths to Main Street investors, was forced to confront the question of what truly drives markets. Is silver's surge a reflection of structural economic shifts and investor rationality, or is it the outcome of a broader interplay of influence, expectation, and narrative momentum? Only time will tell. What we know for certain is this: markets are not just engines of price discovery. They are mirrors of human psychology, political currents, and collective belief. In a world where economic certainty is rare and signals are mixed, silver's journey to 70+ stands as one of the most compelling financial stories of our era. A story still unfolding, teeming with contradictions, and begging for deeper reflection. Subscribe for market insights.